Ladies and gentlemen, traders and investors, a very warm welcome to our channel Polo Vega. On today's video, we shall continue talking about the option strategies and different anchor and offset units that we discussed or we started talking about on our last video. We shall be talking about all kinds of vertical spreads and a combination of vertical spreads where each of these offset units help us bring down the risk of the trade while the anchor units help us drive the profit part of the trade. Prior moving on to the option strategies, we shall touch upon different markets such as the US dollar index, which has managed to come out of its range bound movement because of the impetus given by the Fed during their rate announcement in the foregone week, where the Fed chair Wash decided to take off the dot plot from the market, and instead he started to follow a debasement policy on the dollar, which is going to reduce the liquidity of the US dollar and raise the US dollar index in an exchange to affect or to control the ongoing inflation in the American markets. Likewise, there were similar decisions from the Bank of England and SNB, which is the Swiss bank, who decided to keep the rates steady, while the Bank of Japan raised the rates by 25 basis points. But overall, the effect of the decisions made by the central banks during last week is had an strengthening effect on all the currencies, which has led to the stock markets going down, and the metals as well have suffered a lot of loss during the last week. On today's video presentation, we shall talk about the US dollar index, Nasdaq, S&P 500, gold, silver, and the US oil. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation, therefore, is of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise, recommend, guide anyone to take any trades based on the contents of the video. We do not take any responsibility for partial/total losses arising out of trades based on the contents of our video. The chart on our screen is that of US dollar index, the Dixie, and we're looking at the daily chart. The Dixie has managed to break out of its range, which was between 95.45 and 100.391 for the last 12 to 14 months since April 2025. It managed to break out of the range and close at 101.435, and then it closed at 101.127 on Friday. But it managed to print some explosive green candles during the week, also during week before last, after the decision of the Fed to keep the interest rates steady and the policy announcement by the Fed chair Wash, who said that he would like to be guided by the decisions taken by the strong corporates who were better equipped and more conversed with handling the market information as compared to the Fed. There's been a debasement of dollar policy followed by the Fed during the last 2 weeks, which is trying to reduce the liquidity of the dollar and give it some strength, which will allow the dependence of the banks as well as major institutions on metals like gold, silver, or platinum. And it is also going to have a long-term effect of bringing down the prices in the markets as well. Therefore, one needs to wait and see if the dollar strength continues or it was just a sudden blip, and if the dollar is going to fall back within the range or if it continues to stay strong and bring down the prices of commodities, bring down the prices of stocks, and put a check on the advancement of the stock markets for the next couple of months. The chart on our screen is that of NQ, which is the ETF based on Nasdaq, and we're looking at the daily chart. Nasdaq has printed a doji on Monday, followed by four red candles during the rest of the week. It did gap up on Thursday, but still printed a red candle as there was bearishness all through the day, and then it finally closed on 29368.25 on Friday. He has broken below the high of 30065, which was the high that was broken 3 weeks ago to make the all-time high of 31108. But now there is a demand zone in play as of now, which is between 28501 and 27995. It could see a bounce from this area to go back into the supply zone between 29743 and 30270, with the continuous strength on the estimation made by the market of the US dollar because of its low liquidity and because of the policies from the Fed. One could see an extended period of downtrend up until such time that inflation is under control and the Fed decides to go for a rate cut anytime in December or later during 2027. The chart on our screen is that of ES, which is the ETF based on S&P 500, and we're looking at the daily chart. Similar to Nasdaq, ES as well has printed four red candles during this week and a doji on Monday. The candle printed on Tuesday was the most explosive one, and it's almost close to the demand zone from where it had a bounce about 3 to 4 weeks ago, which is lying between 7272 and 7314. One needs to wait and see if it manages to get a bounce out of this area or whether it breaks below this zone and closes below this zone. If it closes below this zone, then we have an established downtrend on the daily chart, and then the entry level would be at 7445 to 7502 for a show on this chart. We could also try and look at the 240-minute chart for a better picture to go show if we want to. Under the continued strength of the dollar and the inflationary pressures, we could expect the market to stay bearish for a while, so the shorts would be a better trade than the longs. There's a nice area on the 240-minute chart between 7505 and 7515, which could take us all the way down to the next demand zone or the target area at 7314. If we see a bounce on Monday, then this trade could be in play to give us a nice profit with the downward movement of the index. The chart on our screen is that of US oil spot, and we're looking at the daily chart. The US oil spot has had some nice bearish moves during the week. It has managed to close at 69.715 after touching 68.58 on Friday. That's the lowest low that it has touched in the last 3 months, and one could still expect it to come down into the next demand zone between 63.00 and 66.65. That was the zone in play when it started moving up in February 2026 when the war between Iran and the United States of America broke out. So we expect the asset class to go back into the same zone and maybe trade sideways for a few days before coming back up or go back down under the influence of the strength in the US dollar, the inflationary pressures around the world, and the peace deal between the United States of America and Iran that could make the travel of ships free through the Strait of Hormuz, is the increased supply of oil throughout the world and the increased strength in the US dollar that could bring down the price of US oil further. Therefore, one needs to look at opportunities to go into bearish trades or shorts if at all, and not to try getting into the way of the US oil spot coming down to lower areas of trading. The chart that we see in front of us is that of XAU/USD, which is the gold based ETF, and we're looking at the daily chart. Gold has been following its downtrend religiously during the last couple of weeks, and it has had some massive moves during this week as well as week before last. It has managed to close at 3995 on Wednesday and touch 3970 on the same day before coming back up and close at 4070 on Friday. But it has managed to touch its lowest low of the year during this week, and one needs to wait and see if it gets a bounce out of this demand zone between 39780 and 3876, or if it manages to go sideways and break down below this zone to go to the next level, which could be around 3437 or 3500 could be its next psychological area, as well as the area where it has had a very long stay during the previous year. It managed to trade between 3500 and 3150 between April to August of last year. So that was for 4 months that it traded in this zone before breaking up. So one needs to wait and see if the increased dollar strength and the debasement trade that has happened in the last 2 weeks, prompted by the action of the Fed chair Wash and the loss in liquidity of US dollar, we'll see that along with other metals, if it manages to trade sideways, whether it gathers some strength or whether it continues with its downtrend during the forthcoming weeks, as there are no signs of rate cut decisions from the Fed anytime during this year. The chart on our screen is that of XAG/USD, and we're looking at the daily chart. Why we're looking at silver today is purely because of the reason that it has lost nearly 50% of the value that it had gained during this year. It has fallen from a high of 121.737 in January to a low of 55.64 during this week, and then finally closing at 58.439 on Friday. So practically silver has lost all its gains from the high that it reached under the influence of bullishness prompted by the gold traders in this particular year. It started going up sometime in November last year, and it has almost come back to that level of 53.54, which was its original level or closing at December 2025. Silver has managed to come down slowly and steadily to this level as compared to the rise that it had during December and January, where it appreciated by nearly 100% during a period of 30 to 45 days. Now one needs to see if it starts going sideways, whether it picks up more strength or whether it continues to lose its value and goes down further. Therefore, we would request traders to stay away from silver for a couple of weeks to see if it stabilizes under the growing strength of the US dollar and there is a steady direction of drop, or there is a steady direction of rallying back to its immediate supply zone at around 75.00, or it continues dropping further. As spoken at the beginning of our video presentation, we shall be talking about various kinds of vertical spreads where the underlying and the expiry dates of the contracts that we get into shall be the same, whereas the strike prices for various calls and puts that we buy or sell shall be different. So today we shall talk about the credit call spread, the debit call spread, the credit put spread, and the debit put spread. The credit call spread is basically the bear call spread where we sell an ATM or an ITM call option and then we buy a deeper OTM call option. The driving unit here or the anchor unit here is the short call, and the offset unit, which is reducing the risk in this trade, is the OTM call option that we go long on. The idea here is to restrict the losses in our trade if the direction of the trade doesn't work according to our speculation, or if the implied volatility expands or inflates contrary to our expectation of a limited movement in volatility in the market. Continuing with our discussion of vertical option spreads and the role of the anchor unit and the offset units in our option strategies, we shall now talk about the credit put spread or the bull put spread. Here we either sell an ATM or an ITM put option, which is going to be our anchor unit, and to cover our risk we buy a deeper OTM put option, which is the offset unit. The price of the underlying is expected to stay below the ATM or the ITM strike price. The volatility in the market is expected to stay low, and we do not wish the underlying to go above the strike price of the ATM or the ITM. And the offset unit plays its role in cutting out the losses that could occur if we did not put the offset unit in and suffered an infinite loss if the direction went against us. The idea is to stay neutral to slightly bullish so that the price stays above the ATM or the ITM strike price of the put option that we have sold. The net profit is the reward from the trade, which is the premium obtained by selling the put option unit and reducing or deducting the price of the long option unit that we have bought at a deeper OTM strike price. And the risk is the difference between the two strike prices less the credit obtained from the short minus the long. The next strategy that we're going to talk about is the debit call strategy, or the long call spread, or the bull call spread. Here the anchor unit is the ATM or the ITM call option that we buy, and the offset unit is the OTM or the deep OTM call option that we sell. It's a net debit strategy. Why? Because we are paying a higher premium to buy the long that we get into, and we get a lower premium from the short that we get into. Overall, it's a net debit strategy, and the risk of the trade is limited to the premium that we have paid to get into the trade, while the reward is equal to the difference between the two strike prices of the call option trades that we get into less the net premium that we have paid for getting into these trades. The expected volatility of the market is supposed to be high, and we are moderately to highly bullish while getting into this trade, and the only time that we lose money is when the underlying stays below the ATM or the ITM strike price of the long that we go into. In that case, we end up losing the premium that we had paid to get into the trades, and we do not get any profit from the long position of the call option that we got into. We now come to the fourth of our vertical spread strategies, which is the debit put option strategy or the bear put option strategy. Here we go long on a put option, which is ATM or ITM, and then we go short on a deep OTM put option. Why? Because this reduces the cost of getting into the trade. The premium obtained from the short reduces the total cost of getting into this bearish strategy, where we expect the underlying to stay below the ATM or the ITM strike price of the put option that we bought. But if the direction of the trade does not go in accordance with our expectation, and if the price stays above the ATM or the ITM strike price, then we are a loser of the trade, where the loss is equal to the net premium spent in getting into the trade. And the highest reward or the profit from the trade is the difference between the two strike prices less the option premium paid for getting into the trade. Once again, we are bearish in this strategy, and we expect the market to go down and reach the strike price of the option that we sold so that we obtain the maximum profit from this trade. The driving unit is the put that we got long into, and that's the trade that obtains the profit as the underlying moves down in our favor. We shall now talk about the iron condor. In the iron condor, what we do is we sell an OTM call and we also sell an OTM put, which are symmetrically across the ATM or the current price of the underlying, and we then buy deeper OTM call and a deeper OTM put. Again, these two are symmetrically or equidistant from the ATM price of the underlying. There could be a possibility of having an askewed or an asymmetrical iron condor where the call and the put option prices that we buy or sell are not symmetrically distant or equidistant from the ATM of the underlying. But overall, this strategy is a combination of two different vertical spreads. The first one, or the upper one, being the bear call spread, and the second one being the lower one is the bull put spread. Here we expect the underlying to stay between the two OTMs that we've gotten short into, which are the two inner call and put options that we got short on. We do not expect the volatility to be high at all during the life of the trade, and we do not expect any price swings, or we do not want the underlying to move in any direction whatsoever. Overall, if the market is nice, quiet and calm, then this strategy gives us two different premiums that we have received from selling the two inner call and put options less the premium spent on the long or deeper OTM call and put options. Is a net credit strategy, and we would expect the market to stay as less volatile as possible during the life of the trade. Time decay works in favor of us, and therefore we would like to keep the expiry dates of the call and put options as close as possible to the current date on which we enter the trade. We shall now talk about the reverse iron condor or the long iron condor. Here what we do is we go long on a call option and we go long on a put option as close to the ATM as possible. So these are two OTM call and put options symmetrically or equidistant across the ATM. And then we go and sell deep OTM call option on the upper side and a deep OTM put option on the lower side, again either symmetrical or asymmetrical depending upon what or how we would like to go into this strategy. But given the direction of the market to be going or swinging in either of the two directions, we are bound to lose on one of the vertical spreads and gain on the other vertical spread. The vertical spread on top is the bull call spread, and the vertical spread at the lower side of the ATM is the bay put spread. We expect the volatility to go very high or inflate suddenly, or we expect price swings because of release of some market data or some news which is known to us to swing the market in any direction. The markets could go up or the markets could go down, and in either of the directions the violent price swing is what is going to give us the maximum reward in this trade. So if the market price goes up, then the long call is the driving unit that gives us the profit, or that is the anchor unit that gives us the profit. And if the market swings down, then it is the long put option that drives the profit, and it gives us as much as profit as possible, which is then truncated by the short put option that we go into, which reduced the price of the premium paid to get into the long put options. So overall it's a net debit strategy, and the risk is limited to the total debit that we've had at the time of getting into the trade, and the max reward shall be the difference between the strike price of either the call option if the market goes up, and if the market goes down, then it's going to be the difference between the strike prices of the put options that we go into less the net premium paid for the trade. We shall now talk about the iron butterfly, which is the same trade as the iron condor, but we've got an ATM in the center of two OTMs. In case of the iron condor, which was also known as the stretched iron butterfly, as we spoke in one of our option strategy sessions. So similarly, the iron butterfly is exactly the same as the iron condor, except that we get into two different trades on the same ATM or the strike price. So in case of the iron condor, we sell an ATM call and we sell an ATM put at the same strike price on the same underline with the same expiry day, and then we go long on a deeper OTM put option, and then we go long on a deeper OTM call option. The next strategy is a credit strategy, as we are selling two of the center units and we are buying two OTM options at lower premiums. Therefore, the profit obtained from the trade is a net premium received, and the losses are restricted to the difference between the two strike prices of the call option and the two strike price of the put option less the net premium that we have obtained. And that could happen when the implied volatility of the market inflates or expands contrary to our expectation of the volatility to be as low as possible or the market to stay as neutral as possible. And the flip strategy to this one is the iron butterfly strategy, where we buy two ATM options, one call and one put, and then we sell an OTM call option on the upper side and an OTM put option on the lower side. Here we expect the market to have violent swings in either of the two directions, with the expectation of release of some kind of information from some agency that could trigger the movement in either of the two directions, and we tend to get rewarded when the price of the underlying touches the strike price of the call option or the show OTM call option on the upper side, or the show OTM put option on the lower side. Here the market is expected to be neutral when you are entering the trade, and then the trader expects the implied volatility of the market to expand or inflate violently in one of the two directions, making the trade profitable. The anchor units again are the long units in this trade, which are going to drive the profit towards the upper side or the lower side as the underlying moves, and the offset units are the show call option and the show put option, which help us in reducing the cost of entering into the trade. Having talked about all kinds of vertical spreads, the bear call, the bull call, the bear put, the bull put, the iron condor and the iron butterfly, we now come to an end of our discussion on different kinds of vertical spreads. Also, we spoke about the breakout of the US dollar from its range bound trend from April up until last week. We've also seen the way the indexes have reversed, both S&P as well as Nasdaq, more so because of the losses in the tech and the AI related stocks, especially the loss from the recent IPO on SpaceX, which has lost in 3 continuous sessions during the week gone by, and also the loss in the silver, the gold and other metals because of the sudden strength shown by the US dollar. We hope that our presentation has been informative and exciting enough for you to come back and watch all our videos. If you like our video, please hit the bell icon underneath and subscribe to our channel Polo Vega. We thank you for watching our video and wish you all the very best. You can also get in touch with us through our Twitter handle @PoloVega, or you can visit us at our website www.polovega.com. Thank you for watching our video, and please like, share and subscribe to our channel Polo Vega.